Greetings, hello, hi. I hope you guys are well this morning. It's been a long time, but yeah, I'm back. It's still your favorite teacher, the optimal black teacher you could ever ask for, the youngest one. Yeah, to be exact. So yeah, welcome to the A+ class. Welcome to the winning team, whereby teamwork makes the dream work. Yes, I know for the past few videos, previous videos actually, I nearly said weeks. Previous videos I've been tackling economics. Right now I've it came into my realization that there are kids out there or learners out there who are struggling with accounting. So I decided to hit the basics of accounting so that people can understand a few things, because when you understand the basics, it's simple. It becomes easier for you to understand the whole concept behind the accounting. So without any further ado, let me get to it. Today we're going to be dealing with accounting equation, the accounting equation. First of all, we need to understand what the accounting equation is. So I'm going to give you a simple definition. The accounting equation help us to understand the relationship between the assets, owner's equity, and the liability. I repeat, the accounting equation, it helps us to understand the relationship between the assets, the owner's equities, and the liabilities. Right. So now, we're going to start with the assets. We're going to start with the assets. What are assets? The assets are the things of which the business owns. Those are the assets. Assets are the things of which the business owns. Right. Let's now get a little bit deeper on assets, on these assets. We have three types of assets. We have non-current assets, we have current assets, we have financial assets. So we're going to start with the non-current assets. Non-current assets, under the non-current assets category, we have vehicles, we have equipment, we have land and building. Right. So now, under the current assets, yes, under the current assets, we have the bank, we have the debtors control, we have the inventory under the current assets. Now, under the financial assets, okay, let me just give you let me tell you the reason why we say bank, inventory, they fall under the current assets. Because now, something that is current, it's something of which we have right now. When we, for example, the current situation, the situation right now, the bank has our money right now. It's current. That money is ours. That's why we say bank is a current asset. The inventory is the stock that we have. We have it right now. That's why we say inventory falls under the current assets. Okay, let me now go to the third one, the financial assets. Financial assets, it is whereby now we have the mortgage bonds, we have the insurance contracts. Those are financial. And they are the assets. Right. So bear in mind that the assets increases on the debit side and therefore decreases on the credit side. Right. Let's now go to the owner's equity. What are owner's equity? Owner's equities refers to the interest of the owner in the business. Owner's equity refers to the interest of the owner in the business. That's owner's equity. Right. So what do we have under the owner's equities? We have the drawings. For example, if the owner withdraws money from the business, those are the drawings. Then we have the capital. When the owner donates something, when the owner contributes, that's the capital. Maybe, for example, the owner decides to deposit 50,000 into the business account. Capital. That's capital. Okay. So now, and we have the expenses and the incomes. So under the expenses, we have stationery. Stationery is an expense. We have water and electricity, etc., etc. Those are expenses. Then after under the income, under the incomes, we have commission, we have rent income. Right. Now, the owner's equity increases on the credit side and therefore decreases on the debit side. Right. Now let's head straight to the last one that we have. The liabilities. Dikoloto. Liabilities. Now, liabilities refers to what the business owes. What you owe. It's a liability. Okay. So now, under the liabilities, we have non-current liabilities and current liabilities. So under the non-current liabilities, we have mortgage loan. For example, our business doesn't have money, perhaps to purchase raw materials or to pay salaries and wages of the employees. So the business goes to the bank to loan money. To loan money. So now, let's go straight now to the current liabilities. Under the current liabilities, we have what you call the bank overdraft. We have what you call the bank overdraft. What is the bank overdraft? The bank overdraft, it is whereby now we use or you use the money that you do not have. The bank allows you as a business to use the money that you do not have, to use more than what you have. That's a bank overdraft. And you have to pay that money. Then we have what we call the creditors control. The creditors control. It's a liability because that money is payable. You can say creditors control or you can say trade payable. And the liabilities there, the liabilities increase on the credit side and therefore decreases on the debit side. Okay, that was it from me for today. I hope this lesson is going to get in the right minds out there. It's going to be fruitful and it's going to help someone. It will to someone out there. It's going to help someone out there. I believe so. So yeah, you know what it is, man. Welcome to the A+ class. This is the best class, the winning team, bam. The winning team. And I'm still your teacher, Mr. Mopeti here. So yeah, till we meet again. Love you all.